What a crazy time. All right. Happy Wednesday, everybody, and welcome to our monthly jobs report and inflation readout. In these crazy, chaotic economic times, I hope that we can be your source of information, news, and views that you can use to help you navigate this ever-evolving economy and job search. With everything going on since the middle of COVID, we've been running this webinar with our trusty sidekick here and partner in crime, Dr. Reilly White. He is Assistant Dean of the University of New Mexico, teaches an MBA finance course, and he's very well regarded in banking and finance circles. And he's here to help us make sense of everything going on. Silicon Valley Bank, Credit Suisse, layoffs, and all the insanity that's happening in between. And so he's going to give us a presentation today. You're all more than welcome to ask questions, share insights, relay your fears, and everything in between. And I hope that as we go through all of this, especially with a potential, who knows, pending Fed rate hike next week, we can come to some answers on where all of this is going and whether we can find some sanity. And so without further ado, Dr. White.
Thank you, Albert. Thank you, Albert's List. It is great to see all of our excellent attendees. If this is the first time you've seen me, I'm so sorry, but probably I've ruined your, but I'm so grateful that you're here. My name is Reilly White, and I'm an Associate Dean at UNM Anderson in New Mexico, but lots of family in the Bay Area, lots of connections in the Bay Area. Like to do the Bay Area breakdown in particular for Albert's List because it brings me great joy. So let's rock and roll with this. We've got a lot to talk about today. We're going to cover the jobs report, the inflation report, and a little SVB breakdown, as well as kind of a sense of what's going on and how they could get into this spot in the first place. So I'm going to cover a lot of things. I've gotten, my phone has been ringing off the hook. I had a 20-minute interview on the radio today about Silicon Valley Bank, and I was it was on the radio, like one of those really obscure AM stations. It's like, we're going to talk about this. No, they were really interested. And so everyone is sort of looking at this. And one of the things to think about is the way that not only the event itself, but the way it affects behavior across the economic system. So I want you to think about that as we approach this. So I'm going to rock and roll with this today. We're going to cover a bunch of things. As Albert pointed out, it is my great joy and delight to answer any questions you might have. Please do so in the chat window. I'll try to get to them as soon as I can. I'll pause a few times. There's usually good interjections for these sort of things. And then we'll have a Q&A at the end as well, where we can bring up some other stuff. So anyway, let's talk about this. You should be able to see our February 2023 jobs and inflation report, and of course our SVP breakdown. So thank you so much. So anyway, let's talk a little bit about what the jobs report said in February. So we're going to start with the good news, then stuff gets gradually weirder as we embark upon some of the other stuff we talk about that ways the economy moves, what the Fed's going to do next week, anything else that's going to happen. We'll kind of discuss this in a little bit of an interesting light. So let's talk about this. So the jobs report that was released earlier this month was still mostly good. And I say mostly because you heard a lot of news saying, oh, the jobs report is great. Indeed, it is a good number. Adding 311,000 jobs is close to kind of where we'd expect to be in a solidly growth economy without that pandemic recovery. Okay, fair. Unemployment ticks up along with participation. Now, that in itself is not a bad thing. Unemployment takes the value of the number of people who are out there in the labor force, which means they are working or looking for a job, right? That's the labor force. And the amount of unemployed people divided by that labor force number creates the unemployment rate. But when you drop out of the labor force because you're a two working parent household and one person drops out, or you have another situation where somebody retires or something else, you're not actually counted as part of the unemployment rate. So just as an FYI. So where did these jobs arrive from nationally? So we had about 105,000 jobs in leisure and hospitality added. That's an impressive number. It shows faith in consumer expenditure on things like travel, restaurants, those sorts of things. 44,000 jobs were added in health services, 50,000 in retail services, 46K in the government. And one thing that is particularly impressive, given the mortgage rates that surged near 7% before backing off a little bit, is we still have 24,000 in construction. Now that's good, because usually construction employment usually precedes a recession meaningfully, meaning that when construction employment drops off, we're going to have some more unemployment issues. And I apologize, I'm a little bit hoarse, but in the sense that I recovered. Unfortunately, my whole family got COVID again like a week and a half ago. I bought it back from a business trip to Chicago. And so then we had, so then I made everybody sick. So much like a used penny, I will not be able to infect you over the internet. So Albert said what was concerning today in tandem with these jobs numbers was the decline in retail spending last month. Yes, we're going to talk about that in a second. So I like that. And the New York Fed manufacturing number also cratered, like, whoa, you're absolutely right. So one thing is this is the other side of this story. The jobs numbers are good, but I don't expect them to continue to be good for a lot longer. And not only from what you're seeing as the canary in the coal mine, Silicon Valley, not only from the mass layoffs you're seeing from the rest of the large tech companies, but we're also talking about the level of stress consumers are under. And there's been some interesting charts here. And I actually have a chart right here that we can flip to that relates to Albert's questions. And if we actually look at how consumers are doing, why do we have to care about how consumers are doing? Consumers represent about 2/3 of our total GDP output. Consumption, spending money, buying stuff. It's the most American thing in the world. Just spend, spend, spend. But it's the power of an engine of our economy is our expenditures. And so far, expenditures have held up really well. We had a surge of stimulus spending at the pandemic in 2020. People spent a lot of money. People spent so much money, and so much money was floating around in the system. We had inflation. We had goods supply chain issues. Those have been sorted out. But the question is, these are good times from a jobs perspective. Are these also good times from how consumers are feeling from their personal financial situation? And the answer is no. And here's why. Despite the good jobs numbers, if we look across the board, bank card, retail, auto, and consumer finance loans are now delinquent at near historically high levels for most of them. And in the case of automotive loans, we actually have the highest level of automotive loans delinquencies that we've seen. Now, some of that is due, of course, to the fact that automotive loans are uniquely expensive. They surged from about 2% to 6.5% in the last couple years in tandem with the Fed market rates. And so when we think about this, we're looking at this as a testimony. Are consumers stressed? Yes. And so we saw declines in retail numbers and manufacturing numbers that seem to align with that narrative. And this is really interesting. Now, Aaron points out, we can bring inflation down faster, which is more important over 5 years in the short-term business cycle. So you're absolutely right. So if you're thinking like an economist, like Aaron's being a true economist here, and you're thinking about this and you're saying, people and their problems. The long story short is, as people stop spending, if they no longer have money to spend on things, that in itself will control inflation. And this is part of the rise. And this is part of that discussion we're going to have in a second about, will the Fed raise rates or will they lower rates? So one of those things. So we'll talk about this. So anyway, so far it's holding up. A couple of bad things in the marketplace. As you might anticipate, if you've been alive and following the news or part of Albert's list the last few months, there's been a lot of tech layoffs. We actually are started seeing that for the first time in this jobs report. The information sector took a hit, down about 25,000 jobs. And as you break down, what's cool about this, or interesting about this, less cool, is that we actually see that not only in San Francisco, San Jose, at the local level of the Bureau of Labor Statistics survey data in January, but it's showing up nationally in February. And this is a little bit ominous. And so far, the rest of the country, if you aren't operating in those spaces, you view it with sort of a grain of salt. It's not the most evident problem in your problem Rolodex right now. Aaron, Maximus Economist, God of War on my command. That's great. Aaron, I like that. That is also like an economist, to feel like you have absolute power over all things. So that's also, Aaron is I'm just printing him out PhDs there right now. So labor force participation. increased slightly to 62.5%. Participation is usually a good sign in the sense that it shows the amount of the work, the amount of the people eligible or potentially within a population who are actually looking for a job or working. A lot of this is often demographic, though, in nature. People retire, they drop out of the workforce. We had high participation rates in 2000. Those have gone down. A lot of that comes in tandem with our aging population. But if you're looking at the way of at the local level or short-term level, changes in participation rates outside of demographics can indicate people coming back into the workforce to earn more money. Some of this might be due to need. Some of this might be due to feeling more confident about the labor market. So it depends on an individual circumstance. So wage growth actually, and this is really interesting. So the other part of this, and the Fed is paying attention to this will sound bizarre to a lot of people who don't think like you think like normal human beings. You're like, wage growth is good. I would like to be paid more money. So economists, we look at this and we say, well, whoa, hold on a second. High wage growth is a surefire way to power long-term inflation, which is damaging to the economy. You pay people more money. This sounds like I'm a tycoon. I'm not espousing this. I think people should have living wages. But I also think at the same time, we do know that when wages increase very, very rapidly, this is a long-term powerhouse of inflation. That has continued to drop. Inflation not only is falling, wage growth is not only following behind inflation, but it's tracking behind inflation. Even it's falling fairly rapidly. Now it's annualized at about 2.9%. We saw like a 0.2% increase in wages this month, about 0.24, which if you annualize it, take it to the power 1 plus that number to the power 12, you end up with this 2.9% number. So this is not a very high wage growth. This is still positive, but it's tracking behind inflation. And this is not a number that will power inflation over the long run. So that also suggests that inflation will have to come under control, which is, again, the silver lining to challenging situations. So Albert says, March 31st, in my opinion, is the first inflection point when we see a lot of H-1B visa holders see their grace period come to an end. Facebook Marketplace, Zillow, and Craigslist are going to be fascinating. I am very interested as well in how these companies behave, especially through the H-1B process. One of the things, I'm for many, just purely from a purely economic standpoint, you want to be welcoming and involve highly talented immigrants, power a nation's economic growth, and attracting those immigrants and maintaining those immigrants is a really important part of economic growth and dynamism. And that would be very interesting if that dynamic changed, particularly in Silicon Valley. So key numbers. So we added 311,000, about 80.5% of people. That's about as high as it's going to get. The share of prime working age people with a job. There aren't huge swaths of people between the ages of 25 and 54 who are not employed. And then you had about almost 3 million jobs gained since February 2020. Now let's back up a little bit because we got to figure out what the Fed's going to do. So that's in the context of the Silicon Valley Bank. We'll talk a little bit about that in a second. So the inflation update, 6%. Okay. So last month we talked about inflation coming in a little bit high, 6.4%. We expected it to be a little bit lower than that. Right now it's about 6%. About 60% of that increase is shelter, housing, and other things. That has since leveled off, and a lot of that stuff will drop off in the coming 6 months to year. However, core inflation rose 5.5%. Now, the Fed pays attention to a specific version of inflation that they call super core. So core takes out food and energy, and then super core also takes out shelter. And you're saying to yourself, I don't spend money on any other thing other than food, energy, and shelter. Why are you not tracking those things? And so it's the reason that they're doing this is that they're looking at this from a perspective of, how energy is volatile. It's an international commodity. We know that shelter had a lot of interesting. Food is also very tied to energy because of distribution and supply chains. Apart from individual market-based surges that are caused by, say, avian flu, causing egg prices to rise. And then you also have on the third section, you have shelter, which is in itself viewed by the Fed as something that we know that mortgage rates came up. They view shelter as kind of something that's priced in a lag sort of way. So if you drip down to what the actual core is, you're looking at services, things like the haircut you get, other things that affect people's bottom line and ability to spend. And core inflation has been pretty robust. Meat, poultry, and egg prices dropped. Shelter was still a big driver of this. But if we blow it up a little bit more, core versus shelter and used cars, core with private new rent indices for shelter, median, and other things, these numbers are still pretty high in the 12-month period. However, in the 3-month period, even these are remaining stable or coming down. Where the Fed's concern was is that core in particular, if you look at the core and core excluding shelter and used cars, whereas overall inflation over 12 months is kind of showing a dip, we have core and core excluding shelter and used cars. That seems to be pretty stable or even increasing a little bit in the last month versus the last 3 or 6 months. And so they're looking at this and say the Fed came out with that before Silicon Valley Bank failed. And they came out and said, we're going to be very serious about inflation. Jerome Powell was like, we're going to do this thing. We're going to make sure that we're going to hit certain our inflation target of 2%. And he communicated in no vague terms that the Fed is highly committed to bringing down inflation to that level. So what's going to happen? So we have a couple things that are happening and moving right now. And I like this. So let's go to Albert real quick. If Powell wants to raise rates next meeting, he's officially delusional, especially with those layoffs, bank failures, and so forth. That's a good thing. So one philosophy about how the Fed moves is that they raise rates until something breaks. Now, what do I mean by that? Bad economic numbers, higher unemployment, say a series of bank failures. It is very interesting to see what the Fed will do, because did the events of the last week constitute something that would beg the Fed to pause their rate increases? So, of course, the Fed, and yeah, I think so too. I think we're at, I agree, Albert. I think one of the things to think about is, we look at certain signals of bad economic times ahead. You've got 2 highly significant bank failures, number 2 and the 3rd biggest bank failure in U.S. history, number 2 and 3, that happened in the last week. You have Credit Suisse looking on the verge of something happening. We know that their primary investors are looking at this and saying they're not getting any more money from us, and so this becomes an interesting question. And then Aaron says, of course, the Fed won't, but if they raise the discount rate 75 basis points, they would signal earthwide that inflation will be crushed. This would transform middle-term yields, and all rates over 2 years would drop and yield inversion would occur, which would allow credit to begin rebuilding in the middle term. That's really interesting, Aaron. That would be a bold move by the Fed. But I do think, that's part of the thing. I think the Fed is so focused, to your point, on reducing the inflation numbers that right now, being so critical, they're looking for they might still raise it by a quarter. Market consensus before the bank failure was 50 basis points, about 0.5%. That's since come down to 0.25%. So it's very interesting to see. I'm very interested to see what will happen. If the Fed has not been very surprising so far, so I think they're going to probably not do 75 bips as a signal. My bet is they'll increase 25 bips. So Scott said previously, supply chain concerns, the lack of chips for vehicles and devices, and Ukraine's war impact on global energy costs were increasing inflation. True. Are those still factors given the slight difference between core inflation excluding shelter and used cars? It's really interesting. That's the nefarious thing about inflation, is that, like a moving target, the sources of it ultimately change. So we know that in Ukraine's war, in the Russian-Ukraine invasion, that sent energy prices skyrocketing, and energy became a catalyst for higher inflation. And we know that supply chains increase goods inflation. What we're seeing now is service-based inflation, and that's a bit different. So we knew that typically, inflation progresses based on a good shock. When you have a shock to the market, like a huge amount of stimulus money, supply chain issues, that increases the prices of goods. That increases those input costs. But services, we expect it to actually transfer inflation from the good side to the service side. And what's happened is that was a bit more delayed than I think consensus thought. We anticipated more service inflation later on. There's a mixture of things that are driving service inflation. Some of that is labor shortages and corresponding increased costs on labor. Some of that is due to just higher overall input costs within this system, not only from the goods prices themselves, but also from the service work being conducted. This is a typical process of evolution where goods inflation becomes service inflation, and service inflation is harder to treat and harder to kill. And so the Fed is very focused on this. And so, those small transactions and other things are often a better gauge of our pulse. We're no longer, we're a post-industrial society in the sense that although we produce a lot of stuff, it's ultimately, we are a service-based economy. Service inflation has the biggest impact. Albert says, do you want to address how corporations gouge customers too? So it's a really interesting thing. So there's a lot of debate around this and how much that happens or not. It's too hard to rule out and it's too hard to rule in. There are the ways corporations behaved. It depends on how you look at this question. Did corporations with certain abilities, did they raise prices to gouge and increase profits for their shareholders, or were they responding economically rationally to higher input costs or higher potential costs down the line? And that is a source of debate that I think we will discuss as an academic field in years to come. It's hard to gouge in fully free markets. It's hard to gouge and get away with it for long, but we have markets that are not fully free or oligopolistic in nature, where you could maintain price gouging in a way that would actually be egregious to the consumer. But I know a couple of researchers who are working on that question right now. I want to put this, and I think we should talk about it once they get a little bit more data and we can get some research data on that. So when we think about supercore, the Fed looks at a few different numbers. Now, one is that CPI is the one we quote all the time. Consumer Price Index. That takes a representative basket of goods and tracks, how much that representative basket increases and decreases. And it has weights attached to these goods. Shelter has a weight, gasoline has a weight, food has a weight, and it's representative of a typical consumer. And the other thing that businesses use is called the PCE, and that's sourced from businesses. That also tracks inflation. Most of the time, they're in quasi agreement in some way. They might vary a little bit. Now, this narrow definition of what the Fed follows, supercore inflation, which is core CPI excluding shelter, and core already excludes energy and food, is important because it shows that service sector inflation. And when we look at this, let me move some windows around here. We're looking at higher inflation or an uncertain economic picture when we maintain high levels of this inflation for a long time. Now, if the Fed raises rates, as their primary policy tool is raising the overnight rate, which is overnight lending to large banks, the discount rate. And this has a ripple effect on other rates in the economy. Is this going to be effective in itself at reducing inflation down to the Fed's 2% target? As it turns out, the Fed is one, I love the Fed in many ways in the sense that it produces articles that are like, well, this isn't going to work. So the Cleveland Fed came out with a paper in the last couple of weeks that I thought was particularly interesting. This is their economic projections, and they came out with a very interesting conclusion. The only way we can increase rates in a reasonable sense to get us down to the inflation we need is one, a deep recession. That would cause us to get back to an inflation of 2%. Or we have to wait till 2025, in which case core PCE inflation finally drops to 2.75% in their own projection. Now, what do I think will happen here? So first of all, will we have a recession by 2025? I believe we will. And I believe that will accelerate the inflationary decline that we've seen. On the other side of it, however, which is a sad story in that sense, is that if a recession doesn't come, it's going to take a long time to figure that out. Albert asks, okay, Reilly, you believe in the I'm adding extra context. Albert's sitting there saying, all right, this is my list. I hear you have a recession here. How deep is this thing going to be? So let's think about this in different ways. So if consumer spending grinds to a halt, if this regional banking crisis becomes a national one, there's a lot of ifs in there, and the likelihoods of these individual things are low. But there's a bunch of things that could happen to bring us into a deep recession. I think at least a shallow recession is possible. And I think that what ultimately decides the difference is the nature of how we respond to that recession or the early starts of a recession, of which we're seeing now. But you said inflation was transitory. It is till the next recession. But anyway, it's a thing. So this is what we're going to talk. So we're going to get into this little detail about this. So the Fed, even the Fed knows that our deep recession is needed to get us down to the 2% inflation, but they're going to try to raise rates anyway. And so I think that, and you heard that exchange with Powell over this, and he was asked and said, what about people's jobs when they lose it in a recession? And he goes, what about inflation? And that is ultimately how we view costs in different ways. Losing a job is a very direct cost. People feel that in a very meaningful way. That's a very real cost to them. Inflation is more ephemeral. It's hard to put your hands around what inflation means to you. But inflation also does significant economic damage. And the Fed's policy is basically, it's okay to put this thing in a recession. And so all the more reason why I expect it will happen. I have one of the places I consult for collects revenue data that I project for them. And I just got the December and January numbers, and that's a good gauge of, and what it is effectively sales tax data. And sales tax data is off after being very high, after being abnormally high through November. December and January's numbers are off by a sizable percentage from where they were the prior year, which suggests that there is indeed less spending happening. And corporations who have not yet to adjust to this data are going to have to in the next quarter. And then you'll see more widespread layoffs. And that is the problem. And so when you look at a recession, right now we have very low unemployment rate and things are good. But you need, if that ticks up 0.5%, maybe a little bit more, I would argue then we're looking at a situation where we are entering a really bearish economic picture. So anyway, let's talk about our friends, our local buddies, Silicon Valley Bank. So first of all, those of you who are involved in this, if you've worked for the bank, if you've had deposits at the bank, if you utilize this bank in other ways, it's serious. My heart goes out to you. I know that it's been resolved in some ways. You might have owned equity in I don't know if you're an investor in the bank in whatever capacity, but in any capacity, you do have my sympathy. This is going through these situations is always is tragic and terrible. And we're going to kind of walk through this a little bit. I know you know about as much as I do on this, but we'll talk a little bit about the finance side of how this happens. Aaron says the regional banks don't have the liquidity risk to create the crisis. It's a maturity duration mismatch that the Fed Treasury can swap short-term T-bills with longer dated T-bonds, and voila, maybe $500 billion in a T-bill bond swap window. So that's true. So that basically the long story short is on this. And actually, I've got a graphic to talk a little bit about that too, which is really interesting. So Silicon Valley Bank, as you know, was different than a lot of other banks. And bank failures themselves are not significant in themselves always, but it's the nature of what they do to people's behavior and perception around banking that ultimately becomes important. So people looking at this, and a lot of people, frankly, have been, even though they acknowledge the economic risk of recession, have been in la-la land regarding any changes they might make in their own personal expenditures or their corporate expenditures with regards to the level of risk that we're potentially facing. But apart from all those things, so we know that this became the second biggest bank failure in U.S. history. And we know that the instigator of this was a $1.8 billion after-tax loss on their treasury holdings. And to give you a sense of this, so obviously, banks collect deposits. Banks have many ways to how to spend and use that deposits and those other things. And they actually, what made them unusual is that they, in their class, they had the highest percentage of their assets that were invested in securities and the highest percentage of those securities that were invested in very long-term treasury bonds. And I'm going to show you why that write-off happened in a different way. But, and then we'll go into this. And so actually, we're going to do some like finance 101 here. And I know this will be basic stuff for a lot of you guys. I won't get into like the swap stuff or the way we hedge this, but I want you to see how the pricing of bonds work and how they change over time. So I'm going to do a little thing. Let's do a little street finance today. I'm going to crack my knuckles on this. And I'll be doing this. I'll be in Southern California all next week. So find yourself down in the OC, for any reason, look for me on the street corners. I'll be doing some street finance. So let me let me share a different window here and I'll show you my Excel file. We're going to rock and roll with this, just an empty book. So I will note that, please, if you are driving right now, please do not try to attempt to use Excel. Please keep those things. So let's price an example here. So let's say, bada bing, let's say it's 2020, 2021. Let's price a 10-year treasury bond you purchased when prevailing rates were, I don't know, let's say 2%. We'll keep it nice and even. Okay, that's our premise. 10-year bond we price. So you're a bank, you make this investment, you buy a long-term treasury security, you say, this gives me a little bit of a return, I put that money back in. Okay, so how does that work? How do bonds work, first of all? So when the government spends more money than it has, or even when it has enough money to spend, which, as every year since 1996, it spent more money than it has, it issues bonds. And who buys bonds? You buy bonds, I buy bonds, the government, international governments buy bonds. You hold bonds in your 401k, whether you know it or not. Bonds are everywhere. And you buy all of these treasury bonds because the United States traditionally is considered a risk-free asset. So whether or not that's true or not, we keep trying to test every time we argue about the debt ceiling. But the long story short is you have a situation globally where US bonds are just part of the world economy. And this has dated this way back since the Bretton Woods system existed. And the United States was able to dominate global commerce. So when you think about it this way, what does that mean? So when prevailing rates are 2%. So when prevailing rates are 2%, and we're going to assume this bond was fairly priced when you bought this, and you spend $1,000 for this bond. Now a 2% bond pays you for holding it. So you give the government $1,000 and they say, thank you, I'm going to give you an interest payment called a coupon payment. Is 2% of par, or $20. Par is 1,000 in this case, 2% of $1,000 par. So every year, so you buy this bond for $1,000. That means every year you're going to get $20 of interest. How great! But it's better than $0 of interest. So you go ahead and you buy the thing anyway. At the end of 10 years, you get $1,000 plus $20. So you get the full shebang. You get all your 10 years of interest payments and all that stuff. So that's how a bond works. That's why people buy bonds. It's called a fixed income security because it gives you a fixed stream of income. All right. So anyway, long story short. So I apologize if you've seen this before. And I apologize that a lot of you guys come from different backgrounds in this. But I just want you to know this. So let's say the bond, when you bought this bond 2 years ago, it was fairly priced. So I'm going to say this is going to equal a present value calculation. Excel does it for me. The rate is 2%. There's 10 years in this bond. The payment is 20. I'm going to get $1,000 at the end of this thing. So that's the fair price of the bond. So I spend, it's negative because present values are negative because money has to come out of your pocket to buy something. So in other words, you buy this bond for $1,000. Now, what happens when rates go up? Let's say rates go up to, oh gosh, let's say where they are now. Let's say rates go up to 5%, let's say 6%. Let's make it a little bit more dramatic. 5% is fine, 5%. Rates go up 5%. And 2 years have passed. What should the fair value of this bond be? All right, let's rock and roll. I appreciate your patience. We're gonna test your patience. I know. We'll invite my students to be like, I'm testing you right now. So let's talk about this.
Is this a question you ask on your midterms?
Yeah, it is. Oh, this is like what I do on the first day of class. I don't know. Just wait till my midterms. Midterms, I want them to, by the time they reach midterms, they better be solving. I want a full series of pro forma forecasts for a banking system in a strategic risk utilization parameter and a laddered bond strategy. I gotta pass more students. Anyway, long story short, so we've got we've got a present value that's now based on a higher interest rate. So even though, in other words, here's how bonds work. Right now, the market expected me, because of the level of risk of the government, to give a 2% bond. And indeed, the government gave me $20 a year for this thing. It's a fixed income security, which means that even if rates go up and down, that $20 payment stays the same. So let's fast forward 2 years. Now I've got 8 years left in this bond, but rates have gone up to 5%. I'm still only earning 20 bucks, but now the market wants me to earn 5% for this level of risk. Does that increase or decrease the demand for bonds? I don't want a bond anymore that isn't paying me the rational interest rate that I should be getting. I can get 5% off of new treasuries. Why would I be getting 2% off of this old treasury? So what does that do to the demand for bond? Goes down. And what happens? What's the biggest reflection of demand? Prices drop with it. And so what happened is even in this situation, in the course of 2 years, you might have gotten 20 bucks, but the price of your bond just dropped from 1,000 to 806. That is what we call if I don't sell the bond, it's an unrealized loss. And this might amount to a lot of money. This might amount to like trillions of dollars. But right now, I've seen ranges from 200 billion to 2 trillion in unrealized bond losses that banks are holding. Now, Albert says, yes, you can sell a bond early. So why would Silicon Valley Bank need to sell their bonds early to recognize this loss? Because they have depositors who need their money back. And they've invested so much money in long-term bonds that to fund these deposits flowing out, they actually have to sell bonds at a loss, recognize that loss, and then what happens is that becomes a self-fulfilling prophecy. So this is a really good question on this, because you're looking at this and saying, Reilly, Albert, to your point, it seems pretty risky to me to embark a situation where if I'm putting a lot of money in long-term bonds, knowing that they move up and down a lot based on interest rates, and if my depositors want their money back, I'm going to have to sell those at a loss, and that can create a vicious cycle. And you'd be absolutely right if that's what you think. So now there's something interesting here, and you've seen this chart. This is the chart from the Financial Times, and let me switch windows here. I'm going to switch my PowerPoint back again. So they had a $1.8 billion realized loss when they actually had to sold this off to make way for capital. And that made investors nervous, because they realized that this bank was in a position. They wanted, Signature Bank, similarly, spooked by SVB's failure. $10 billion of money flew out of the system. A bank's capitalization is based on their deposits. So when we think about it this way, when people move their money out of it, banks fail. That happened to me when I was in banking in 2008. I worked for a large bank. We had 2 big states as depositors. Our stock price dropped. That spooked the states. They pulled out their money. We fell below our capital ratios, and we were sold in a fire sale for $2 a share. I ended up losing like 95% of the value of my own shares. Now, Silicon Valley Bank was really interesting because they were not hedged well against this risk. And that is an interesting decision. So when we ask questions about fiduciary duty, one of the ways that you think about everything in the concept of finance is based around the concept of risk management. So the aspect is what happens in the worst case scenario. It's all catastrophic thinking. How do we evaluate this? What do we do? What happens? How do we take place in this arena? They were uniquely, Silicon Valley Bank, right there. Even though they had a really high capital ratio, if you adjust them for the unrealized losses on securities, you see how quickly that capital ratio unravels. And there's a few reasons for this, and that's a good point here. So this is good. Thank you, guys. I'm catching up with the comments here. I appreciate your patience as I went through this. T-bills, Desire PR Com Team, Silvergate, good discussion there. In reality, SVP was an industry merchant bank, not a retail bank. 97% of deposits were not FDIC insured. That's true. We're going to talk about that in a second. So that's good. Let's see. SVP was industry. Yeah, I got it. We are a special tech bro, my SVP settlement. We are a special tech land bro mindset. All right. I like that, Aaron. That's true. So yes, so the point is though, yes, let's start with this. Can VCs take risks? Of course. We know that's how they work, and that's how you make money. We also know that SVB on the other side, when you look at it and you take risks and you don't adjust for it and apply that to banking, unfortunately, banking rules still apply, where your capital ratio is based on your depositors and the ability those depositors feel you have for making things happen. So this is really interesting. Colin on Facebook asks, is there any truth to Frank from Dodd-Frank claiming that Signature Bank was not closed because of risk, but because the feds wanted to send a message to banks when they do business with crypto. That's funny. Barney Frank, former representative from Massachusetts. Yes, so he that's really interesting. So I've met Barney Frank before because I used to live in Massachusetts, and he's a friend of a family member, and it was an interesting thing. And they used to do like a trade commission to the Azores. So it is true that Fed, and I do a lot of research in crypto, and this is a hard thing to gauge. There is not a space in the contemporary regulatory environment that is friendly to the crypto culture, which I think is the most neutral and well presented way I can present this. So when do I think that it was targeted for these reasons? I do not, but I think that the bank itself, when you looked at these things, the Fed wishes to send a message on crypto assets, but at the same time, and I want to note this, the fact they're trying to communicate that they wish to make depositors whole, at least in the case of Silicon Valley Bank, they are trying to remove contagion out of the system and trying to reassure depositors. And that is not, if you wanted to punish crypto itself, you would actually go after the crypto depositors, who often, the average crypto depositor isn't a multi-billionaire. The average crypto person is somebody with a little bit of extra money and time, and they can do other things. So I don't know. The hard part is fundamentally, their depositors moved out of the bank, their capital ratio dropped, like in Silicon Valley, and as a consequence, this can happen in a blink of an eye. And where regulators themselves lack sufficient, what am I trying to say here in a neatly way? So where regulators lack a sufficient amount of information and technical capability, often, regulations date from a time, even in banking, even 10 years ago, 15 years ago, it was much less common to get on your phone and demand your deposits within minutes. Now, this is par for the course. You can go out and demand the deposits from your internet bank immediately. We used to have other strategies. They could close banks, call bank holidays when there were bank runs. That's no longer possible given the connectedness of our society. And people can quickly find that, yes, your capital ratio, in the event of losing big depositors, can quickly fail in a huge way. And I think that in itself, and the evolution of how banking works, is more to blame than this, and people being able and willing to be transitory of these things. And this has been hard. It's hard on regional banks over larger banks, because where do people put their money? They withdraw from regional banks and they put them in bigger banks. That's cool. Aaron says he met him too, econ grad school, before I dropped out in 96. SVP bought warrants for loans, credit to startups. Their portfolio is a train wreck. Yeah. But also look at the other banks on here too. If we look at unrealized losses based on the most recent data we had in quarter four, we're looking at Bank of America, very solid here. They have a huge amount of unrealized losses. Zions Bank, Huntington Bank, First Republic, Truist, U.S. Bank Corp. All these would drop below idealized, roughly the idealized capital ratio in a very short amount of time if they were forced to recognize those losses. But the odds of that are still relatively low. So what do we know about this? Among its peer groups, very few banks operate with this depository structure. 2.7% of SVP's deposits are under $250,000. That is a huge amount of large deposits. And this is what was so nerve-wracking was. And the Fed, of course, FDI insurance limits this up to $250,000 per account. And we know there's ways around this. I open a bunch of accounts, I spread the money around. But for most people, if you're a big depositor in a big banking relationship, you do have a lot of money with a bank. And there are consequences to this. So if we compare it right across the board to banks that are similar in size, capacity, and other things, they're right there. Only the Bank of New York has a lower amount of insured depositors. So looking at this caused a lot of concern, not only among the VC community who maintains strategic relationships with this bank, But the Fed realized that this would quickly become a contagion. And what they have is they sort of normally when they step in and involve a bank in sale, they don't typically guarantee all depositors have their money back. What they did was say, they sacrificed the equity in bondholders. And they said, at the point of sale, depositors will, of course, always be made whole, et cetera, et cetera. In other words, they were guaranteeing the deposits, even large deposits of VCs. Now, this is quite, this is always a debate people have. Did this create an inadvertent moral hazard that would be disastrous? It does create some moral hazard, but the question is if we weigh that against what would happen if we had a contagion. If the VC market was denied a whole bunch of deposits, there's a lot of things from, say, foundations to pensions. A lot of places own PE, a lot of places own VCs, and that would have long-lasting effects across this industry. And so the Fed coming and making depositors whole was, in a way, still a bailout, but to the extent that that it helped preserve more adverse economic activity from occurring, which would be certain. Like, we don't live in a vacuum. They did crappy risk management. And to your point, Aaron, their portfolio was a train wreck, but they still did it. 55% of SVB's assets were securities. This is huge, by the way. Most of the time, a quarter of your asset securities is probably more normal. Having this much assets as securities is ridiculous. And 48% of these were long-term, which is also just madness, because normally you might maintain a portfolio that's laddered with different durations. So you're looking at this and saying, my goodness, why did this happen this way? This is just an absolute amazing train wreck of a strategic initiative in a rising rate environment. And I feel terrible for people that work there involved in this. It's not your decision, it's not your fault, but higher level executives should have had the wherewithal to understand what the consequences are in a higher risk environment. This is really, really interesting. So this is really interesting. Yeah. So Christopher asks, why was First Republic cut to junk by S&P Global? Aaron says as First Republic's equity dropped, their bank equity collateral ratios fell, hence their risk profile exploded. That's true, Aaron. So as you point out, they're dropped to junk because we look at these things. What ultimately determines things like Fitch or S&P or Moody's when they rate a company, they're looking at a lot of specific formulas for the nature of how the company works, and a lot of that's based on their ability to repay debt. And that was adversely impacted by clients removing large amounts of money, which completely messed with their capital ratios. And this is the thing about banks, and I mean this, I was part of a well-capitalized bank until it wasn't. As long as your depositors in aggregate are able to maintain their deposits there, you will be well-capitalized. But if people lose faith in the banking system, in any individual bank, and you remove that capital in mass, this will adversely affect ratios right across the board. Albert says, Colin says, is this a sign to other banks that the Fed is always willing to make their depositors whole, as long as they create contagion circumstances? Therefore, risk management should prioritize moves that include contagious risk to capitalize on this Fed behavior. So this is a really good question. This is analogously, this is the moral hazard problem. And Colin, you put this very well. And I want to reiterate to, one of the one of the really interesting aspects about this. So in moral hazard, we know the government can back up an individual bank failure, a few bank failures in those assets. The government does not have the trillions necessary to back up an entire banking system. When the European Union and Greece were negotiating on the restructured debt for Greece, remember the Greek financial crisis? So Greek bonds became really, really expensive. And as part of a refinancing agreement that was sponsored in part by their negotiations with the European Union, the Greek government allowed people to voluntarily buy back their bonds, trade their high interest bonds that the government was paying for low interest bonds so the government could remain solvent. And so imagine if you're sitting there as a bondholder, you have a choice to make. I can sit on this 10% bond that's giving me a solid stream of income, and perhaps the country will fail and be unable to pay me for my bond. Or I can refinance my bond with the Greek government and only get 2%. I will still have my money back though if this happens. But it was very interesting because it was a voluntary behavior. So obviously there are people operating in this space that know and say, wait a second, I know a lot of people are really afraid of their money being lost and they're going to exchange their bonds. I'm going to hold on to my bond. And I know that every person that turns their bond in will make it more likely the government will still be able to pay my really high interest bond. And about 10% of bondholders still kept their bonds. So it's a really interesting thing. So it is a strong signal the Fed sent. It will probably keep more bank runs from occurring in large ways. But given that we have, I think the Fed can quickly reverse course, and they might strategically do so on bank failure 5 or 6 or 10, if that was not the case. So it's something that I think creates a moral hazard, but it's not fundamentally sustainable. If we simulate this out, the government can't afford to back all the deposits in the country. So Marcia, that's a really funny link too. This is really good. This is really, that's really funny. So Marcia's link is a Foxtrot classic. That's really good. That's really, I feel like this every day. Aaron points out St. Louis Fed on the economy 2023. Very good. Rising interest rates complicate banks' investment formulas. Absolutely. But the thing is this would happen. That's the thing. Inflation is high. Maybe they can't. And that's the hard part. You can argue that risk management didn't incorporate this. It's been 40 years since we saw rate increases of this level. People with the expertise on this have retired. It's easy to imagine how we can get behind on this. So banks above systematic risk institutions have a radical risk management oversight mark to market above 250 billion. So that's true. I think what we're looking at, I think the government will step in where there's a contagion issue, and they won't for banks that don't have a contagion issue. What does this mean? It does mean back to that too big for fail philosophy that we had before. And although the banks might fail now, the depositors might be okay. And then we can think about to what extent do depositors then, they are seemingly the people we should bail out if that happened, because hypothetically bondholders and equity holders maintain some leverage, individual depositors maintain less so. We can have a corporate governance discussion of where the power lies in these dynamics. Depositors, though, do not have that sort of level set. And it's a very, very interesting thing. So anyway, let's talk about where do we go from here. SVP was clearly a very different bank. VC focus, asset management style, completely different. They funded long rate fixed assets, which are required to be marked to market with variable rate funding. Now, this is terrible to do it to this magnitude. It happens all the time, but it's terrible that they did this much of it without a corresponding hedge. And contagion. So why did we take action to do this? Why did they make all depositors whole? Because they're worried about the negative consequences across the board of everybody else. And then when you think about the Silicon Valley deposits, the deposits expanded rapidly. And in light of the low interest rates of 2020, 2019, you can see why somebody might be tempted to put money in long-term bonds that generate rates of return. However, you should have laddered that or hedged that in a reasonable way. And to give you a sense of this, the bank failures of Signature and Silicon Valley are so big. Look at all the other bank failures we've had in the country. Apart from Washington Mutual, everything else it's small beans. Small beans. And regional bank crises are big deals. When I worked in Boston, everyone talks still about the Bank of New England failure in the early 90s. That was that haunted us. It is likely that the Silicon Valley Bank failure will continue to haunt the way that VCs and Ps operate in the capital markets in the Bay Area in the short term. This is bad news bears, because it does change. It is important in the way that it changes people's viewpoint on safety, on business, and it also creates a sense of vulnerability that we weren't exactly feeling with the aggregate economic data that's come out lately. So think about this. Unrealized losses on investment securities. How much do we have? A whole ton of them. If we look at them, whole Hilton maturity securities and available for sale, we are dealing with, because of the bond rates that reduce bond prices, we've got a whole bunch of unrealized losses on investment securities. Now, they don't have to sell them if they don't need to. And this is a waiting game. Banks are going to continue to hold on to these assets and unrealized losses They might shift out of them in a very slow and deliberate way, which I think is a strategic move if they're looking at it, and hedge them in different ways. But right now, because of the scale and magnitude of this, the banks are also waiting. When there is a recession, rates are going to crash again, and those bonds will go from unrealized losses to flatlined or potential gains if they drop a lot. So there is some benefit to it, and it's a waiting game. And what's causing people surprise is they thought the period of high rates was going to be a lot shorter than it is. And the Fed's saying it might be longer. And it will be long until we have a recession. Ah, man. Anyway, what do we got? Questions about this? This is cool. How are we doing? Are we doing okay? I got really long on that stuff, but it's super important and it's super valid. I know we touched on it.
Yeah, we're doing good. We
Okay.
need this.
Albert, what else you got in Albert country? We're gonna, before we head off to other economic data I want to throw your way.
Oh, I mean, I think this is all fascinating. Like, yeah, I mean, are we going to see more of these bank failures, and where's that going to go? And I guess the other question is, right, like, how do we, I mean, I think Aaron answered this, that banks are systemic risk institutions. And so, yeah, it's crazy. Crazy money is made and lost around here, huh?
I know we timed this webinar well. We actually waited where Albert and I discussed, I think Silicon Valley is going to fail in a couple of weeks. We talked about it, then we put it here. No, we didn't know. And this is
when we do this in April, what will have failed by then?
I know. Hopefully not much more. Maybe we'll be talking about Credit Suisse, maybe not. So it's really interesting. And this is where it gets really, really fascinating, is what other, and now investors are going to be very keen on this, what other unreckoned with investment scenarios are we looking at across the market? So going back to 2008, even though the Michael Berry types understood the risk of mortgage-backed securities, most banks didn't. It took the failure of a large bank for people to look very carefully at balance sheets in banks. And then it did set off a chain reaction, which caused a lot of reckoning for a lot of these different things. And I suspect for the next few months, we'll be seeing a lot of different news around this. But as a consequence, and what worries me a bit more is this going to be the catalyst for a recession? And it might as well. We've been waiting for a catalyst. We've been waiting for something. We see that the sparks have been lit. The Fed, Jerome Powell's there with a can of gas, just putting it around the section and looking at this. Albert says, is now a good time to buy? I mean, good God. Well, here's the problem with that. So I had a student ask me this the other day, and I went back and I looked at how recessions, how the stock market performed in and out of recessions. The stock market's never bottomed out before a recession. So there you go. Keep that in mind. But maybe this time is different, quote unquote. So anyway, other things to note in the market: house prices finally sliding, but for all the wrong reasons. We actually had one of the lowest drops, about 13.9% on our period to period level of median price, which is significant. And you're seeing that across the board. And, these prices are in response to the much higher mortgage rates across the board. Colin asked, with the tech layoffs and now the banking crises, is now possibly the worst time to be job searching in the Bay Area? Is it an employer's market? So here's the thing, sector by sector, it varies, Colin. So in some sectors, yes, if you're one of 10,000 of the same type of person who was just let go, it can be challenging to recover that position again. However, and this is the side point, people think we put ourselves very quickly, even with years of experience, into certain boxes that enable our behavior. It is not a bad time in aggregate to look for a job. In specific subsectors, if you are a sector where people are trimming, there are still opportunities and still availability. However, I think if I look at all the evidence to suggest stronger versus weaker job market in the months ahead, there's a lot of evidence to suggest our job market is going to weaken. Like superficially, we have almost over 10 million open positions. And that's almost double what we have for the total number of unemployed people. How is this so? There's a mismatch between what types of jobs people want and what people are qualified and willing to do. And because of that mismatch, there might be a lot of open jobs, but just not your ability to do it. It's unlikely if you've been a programmer for the last 5 years, you're going to take that for a wanted sign to be a waiter or a waitress in a restaurant, because that's outside of your primary skill set. And it might pay less than what you're accustomed to. But there is a level at which we all do certain things. Like, I mean, there's nothing. I look back at this, at the different jobs I've had. You know, I'll be a hotel desk clerk again. I'd be a janitor again at some price. So people need to get mobile if they can. Aaron says go to places that are not staffed with people with your skills. So this is true too. So your point, Aaron, is actually very valid. You are dealing in the Bay Area. You're the most competitive market globally in certain technologically themed sectors. Your skill set somewhere else. And I mean, literally, it could be lab work at the government. It could be other things in other capacity, lab work, meaning like Livermore / Sandia / Lanel / other places. It could be other cities and towns. Your skill set is incredibly valuable there, let's say it. But that also reads back to Albert's original point. We had this discussion last year about exodus from the Bay Area. You know, these job losses, if people are not able to make it up, and because of the high cost of living, people will start thinking about looking for those jobs in other places in mass, in more ways than they're even doing right now. So absolutely correct, Aaron. Absolutely correct. So what's the bond market saying? So one thing you look at, so this is a couple days ago, this is a screenshot from Bloomberg. So I looked at this and, this is really interesting. So this is the implied federal funds rate. So the Fed raises rates to control inflation. They lower rates when there's a recession and bad economic news. They're still calling for a flip, a pivot sometime in like June or July, where the rates meet their maximum and then they start going down. Why would the Fed cut rates? The Fed will cut rates in response to a recession. So I still believe that the rates will go, the bond market even thinks that there might be a recession at the end of the year. Other things to think about. Unemployment claims. So in California, they've risen significantly, 26% over last week. Unemployment claims across the country have also risen. They're spotty. It goes up and down in very unpredictable ways. Weekly initial claims, though, jumped up in the first week of March. I think we're going to see a trajectory upward in the coming months. I showed you this beforehand, before the coming storm. Behold, the coming storm. Delinquent consumer loans by type, right across the board. Everybody consumers are feeling the hit, and it's showing. Now, LIBOR, London Interbank Offered Rate. Still important. You remember they had a crisis a few years back when people realized that a bunch of bankers were getting together and fixing it. And then people said, no, we can't use LIBOR anymore. We're going to use prime. And then they secretly just kept using LIBOR. So LIBOR, which is often used to price the rate on loans for companies, has now shot up to 5%. So in banking, that was, if you're in commercial banking and you're pricing something, you're pricing it off of prime or LIBOR. LIBOR went above 5%. And for the first time in 15 years, should be first time in the last 15 years. This is significant because this increases the cost of borrowing for firms. So firms across the board who use LIBOR particularly, as they get those revolvers, as those things come around again and they're looking for refinancing solutions, they're going to be paying significantly higher rates than they were last year or the year before. As a consequence, this will have an adverse impact on investment expansion hiring. So bad news bears. This is a delay. This is a lot of stuff gets baked in later, but increased investment costs will be part of a more challenging job situation towards the end of the year. I like that Aaron's selling people on St. Louis. It's so affordable there for real estate. Look it up. I was on Zillow. I like to look at various places and think, man, where could I live in those places? So the other thing to think about, the most inverted 10-year yield curve since 1981. Inverted yield curves happen. Normally they're upwardly sloping because people get higher rates. And what a yield curve is that connects all those different bond rates, 0, 5, 10, 15, 20. And I also want to point out, if I use a lot of lingo and jargon, I get so used to my incredibly smart and talented group of folks here. If you're sitting there looking at this and saying, what do you mean by these terms, Reilly? You can send me a private, if you send me like a private message to me and say, Reilly, could you explain this and this? I'll never call you out on it. Don't feel embarrassed. It's not your fault. It's not one of those things. This is an educational environment. So if you want me to explain anything in greater detail and you don't want to put it in the comments, just let me know. There's no worry about it, no judgment from my end. So anyway, so we look at yield curves connect sort of the different maturities for government bonds. And it's like a connect the dots thing where you have 0 all the way up to 30 years. And anything less than a bond that has a maturity less than a year is called a bill, or more formally, a William. But we have that long series. That's a joke. But we have a long series, a dad joke. But we have a very long series of time that we look at a curve. Normally it's upwardly sloping. That makes sense. People need to be compensated with higher interest rates for longer terms. When it's inverted, when it's downwardly sloping, meaning that shorter term bonds have higher rates than longer term bonds, that has predicted a recession in 8 of 8 last recessions have been predicted by an inverted yield curve. And not only do we have an inverted yield curve, we have like the most inverted yield curve we've seen in 40 years. So let's talk about deposits a bit. So this is really interesting. So how are banks making do with what they've got? And I'll move some things around for the cheap seats here so you can read it. So deposit outflows are actually making banks rethink about certain things. And this is also going to stress banks' profitability in coming months, because people are moving deposits now. After keeping them stationary, they're moving them between banks, and to fight back, banks now have to raise the interest rates they've been given. So what happened is that interest rates were kept really, really low for a long period of time. Even though money market rates increased in tandem with Fed rates, savers who buy those long-term, just your checking account, those rates have increased very, very little. And you have a giant gap that appears here. Now, the gap is used to finance bank operations. Usually in times like when rates are low, like in 2021, the bank actually subsidizes effectively maintaining these accounts because of the overhead costs and other things. They make money, they make profits when rates go up because their margins increase as a proportion of that. But right now is that people are now being hyper competitive with those deposit rates, and money is now flowing more rapidly between institution and institution. And as a consequence, to catch up, a lot of banks are having to spend more money to attract depositors. So let's think about this. And so market woes, and this goes back to Albert's point, is out to time to buy period. It depends what you're buying. The 6-month treasury bill yield is on the verge of surpassing the S&P 500 earnings yield, which is a really interesting thing. That hasn't happened anywhere near recent times. And this is really, really interesting. So we expect that even market returns are disappointing. People are so geared, short-term rates are so high. There is a great amount of uncertainty in market performance in the next year. And as I pointed out, markets never bottomed out before a recession. Also, as if you needed something else to hear bad news bears, after a period of time where used car prices seem finally under control, they're rising again based on incredibly low historic inventory for these cars. And if there's not a lot of inventory floating around, that allows used car salespeople to sell them for higher prices. So those have been rising as well. Looking at this, so you had a couple big news points come out this week. You've seen it. San Francisco and Bay Area unemployment rates jump up to 2.8%. Article by Roland Lee. This is really interesting because, this is a tangible, significant jump from 2 to 2.8%. We're going to see this more and more in the next few months as those tech layoffs finally appear in the data. Unemployment claims are up. And even though they didn't release officially from the BLS their data for unemployment for San Francisco or San Jose, oddly, we know unemployment went up. Not only did total non-farm employment actually go down in the Bay in San Francisco, but if we focus on a few sectors, information had lost 4,000 jobs here. Information lost almost a little bit more than 3,300 jobs in San Jose. So if we combine that together, that's a net loss of 7,300 or so in the Bay Area from just one sector. That is significant, and it is significant. And this is going to continue to rise. And as a consequence, I expect this will spread to other sectors throughout the year as sort of the national economic malaise sets in. And how deep the recession will be will depend on what the Fed does. Orange cap. Oh, look at this. Aaron said, oh, this is fun. I missed a whole. Look at this incredibly challenging question about Paul Volcker. Aaron Volcker. I'm going to call Aaron. Aaron says, I live in Teaneck, New Jersey, which is what Paul Volcker's hometown he was raised in. That's fun. What a coinkydink. That's cool, Aaron. Do you feel like you're ready to make drastic monetary policy changes that depart from your predecessor's intentions? We should talk about the San Francisco Fed as a risk factor in SVB failure. Oh, yeah. Okay. Yeah. So Aaron, yes, you're right. I put a note about this to talk about, and I didn't talk about it. Thank you for bringing that up. So let's think about this. When you evaluate risk, so banking industry, one of the popular things about working in banking, coming from banking, before academia, before doing the academic route, like the first day, people are always like, welcome to the most regulated industry in America. And welcome to the most regulated. It's always like, welcome to the most regulated. I'm like, yes, regulation's important. But the point is, though, is that regulators themselves, how nuanced are they? How careful are they? And when it came to SVB, it's clear that regulators did not understand the risk the bank was taking. And we know that because of the quarterly reports that are available and annual reports that are available from all the stress tests that have been done, other things that Incorporated did not foresee a failure of this magnitude at SVB in any meaningful way. They were given very significant green lights through most of their history. So whose fault is this? And this is really interesting. So in San Francisco, at the SVB itself, you've got the risk management at SVB and the executives who are in charge of risk management. They're clearly at fault. And then you have, of course, the San Francisco Fed. You have the regulatory body looking over this, and different banks have different regulatory bodies. Depending on it, we have thrifts are regulated with a different regulator, and you have all these things. But if you're an FDIC regulator or the Fed regulates you, the San Francisco Fed in that case, what were you looking at where you didn't, if they were sitting on unrealized losses of this magnitude? And back to that chart here. Oh, I didn't paste it. Hold on. I'll just recopy it. I just got to copy over everything. There it is. So back to this chart here, that if you looked at the unrealized losses of the bank and adjusted for their tier 1 capital ratio, the bank would have no capital. So this should affect, logically, the regulatory actions that you take. And it did not, which is a catastrophic risk management failure. And fortunately, depositors in this case did not lose money, but in future scenarios, they will or would. But oh man, that was our tour de force around this. Thank you for your time on this. Oh my gosh, we still have 11 people. This is great. We still have some people in here. Thank you. So I thought I would look back to this board and everyone would be gone. I'd be talking to Albert and Aaron.
We're all still here, but yeah, where do you think the job market is headed, and what is your advice for job seekers who are watching this now or later?
Yeah,
in terms of what to anticipate.
Oh, super cool. So thank you again. I apologize for my hoarseness. I hope I hope it came through and you can understand me. But as Albert asked, the job market right now is at a turning point. We're at a pivot point. I don't expect a large number of more good job reports coming in aggregate. I think a few catalyst events do force changes in firm risk-taking behavior. I think the Fed will likely, they might have another 1 or 2 or 3 interest rate rises in their pocket if they can't get inflation numbers down meaningfully. I think that combined with all of these other behaviors will bring us into a recessionary environment. The depth of the recession is unknown. That depends highly on consumer response combined with the Fed and government response in response to that. If the Fed is highly responsive in reducing rates, they can minimize the impact. If they delay and if there's no stimulus forthcoming, if we end up in a situation in a year or 2, year and a half, and we have a recession and there is nothing else, and there's no stimulus from the government, which is very possible because the government is very, after the stimulus of last year and the year before, it's very hard to, it would be a significant event that would force them to see the urgency of this, then we'd be in for more of a longer and deeper recession. So this is a really good question.
And so is it appropriate to say that our soft landing that we've been talking about for a year plus now is no longer in the question?
Before the bank failure, Albert, I was not, the pendulum was swinging back towards maybe there's not going to be a recession. And I was still of the mindset that we were still going to have one because I'm looking at consumer data and other things. I think we still will. I think, I'm going to be consistent with where I was before on this, in that I think that a recession is likely. I think that the depth of the recession is unknown, but I think that it is and continues to remain likely. And I think that, yes, I don't see, I see a lot of things that can go badly for the economy. And I don't see a clear route to an sustained economic growth period without a change of a paradigm shift.
Hmm.
And that would be caused by a recession or something else.
Yeah.
So that's the hard part, is that if you think about it this way, so like right now, I mean, people feel wealthy when the house prices go up. House prices are going down now, and they're going to continue to go down because rates are really high. Rates were high 40 years ago too, but asset prices are also lower. And there's a relationship between those two things. And people miss out on that sort of very reinforcing psychological aspect. If people are worried about the economy, if firms are worried about the economy and their bank holdings, they'll start spending, investing less, they'll be more careful. Meta might, have 10,000 layoffs, but in other corporations can poo-poo that. But I think there is risk that will spread to other fields outside of tech. That are consumer focused in the next 6 months. And that's going to be the interesting thing. So pay attention to those consumer spending numbers, other things that will be a good predictor of where we'll end up shortly.
Wow. And so if we're going to pay
Hey.
attention to one big data point over the next month,
Just
before we
data
meet
all the
again,
time.
what
And let's
would that
discuss
be?
it. And let me know what you want to cover next month when we talk about this shenanigans. So yeah, we're always about it.
Yeah, no, I mean, I think, it's evident, right, that we can look at the CPI gauge or the jobs numbers that come out in April. But is there any other number that
Oh
maybe
yeah.
we want
I
to pay
mean,
attention to
I
that?
love those retail spending numbers. I love those consumer spending numbers. GDP is always delayed in those senses. Get those manufacturing and retail numbers, and keep an eye on all those as they come out. That's the gold mine. I need that predictor, and also keep an eye out for this. The equity markets are smart sometimes, and dumb in other times. There's a lot of herding. There's a lot of signaling, but equity markets in clever ways can weed out companies that might be on the verge of failure. And sometimes it becomes self-fulfilling. And I'll tell you this realistically, when unlike if you short a regular company, and a short is when you, for those of you who don't know the financial terminology, when you short a stock, you actually borrow shares from the broker, you sell them immediately, wait for the stock to go down and buy back those shares and pocket the difference. So I borrowed shares for $10 a share, sold them, pocketed the money, bought them back for $8. I pocket that $2 differential minus some interest. And when we think about where shorts exist and where shorts lie, sometimes they're catastrophically wrong, like in GameStop, and they're made to be wrong. But sometimes they're indicative of a potential bank failure. When there is stock market movement, unlike in a company like GameStop, where the company will continue operating regardless of what the stock price is doing, banks are prone to depositor withdrawals, and the stock price drops in banking, people get worried, they remove their money, and as a consequence that creates a self-fulfilling prophecy of bank failure. So keep an eye on those things too, but also note that a lot of this has been muted since there no one to the question we had earlier, Colin's question and Chris's question, but Colin as well, when he noted that, does this create a moral hazard? And it really does. So we don't know what's going to, which companies the Fed might let fail or not.
Wow.
All right. I got all shenanigans into there. Anyway, that's all. Anyone have any other questions I can answer? Anything else that's on your mind?
Yeah, any other questions?
I appreciate you all coming. Thank
He's
you
here
so
to give
much.
you a free MBA course every month, almost.
I did Excel today.
You did
God.
Excel today. Yeah.
You guys are my favorite group for staying in here. Just email me. I'll write you I'll give you like a prestigious it won't be a real degree, but it's like a non-accredited degree. It'll be like Reilly White University. We'll give you a master's.
A letter of recommendation.
In Albertonomics.
Oh, so yeah, Colin was asking, just how bad is Credit Suisse? I know we didn't go into that.
Oh God. So yet to be determined, but the fact is they made so this is really interesting. This has been like a very slow burn, where Silicon Valley Bank was like, oh my gosh, it's real, the bank is fine, and then we have this loss, and then suddenly it closes that, within a short amount of time. So we just had news right now. It looks, Credit Suisse actually has to borrow from Swiss National Bank to the tune of $54 billion. They've been making a series of very interesting credit moves now for, I feel like, some time, because this has been circulating in the finance meme boards for an infinite amount of time. The reason that this will go down is completely, you know, beginning last year, there was a lot of pressure on them that said, you know, wait a second, this bank could fail. The bank actually stepped in and said, we have a strong capital position. And a lot of this stems from losses they achieved a couple years earlier, I think 2021-ish. You remember those failed hedge funds, those scandals, Greensill, and the other one, Archegos. So a couple of these large hedge funds, which they had holdings in, failed. And that set off a potential series of risks with them. And risk in banking is really interesting. Some of it can be based on rumor. If your capital supplies dry up, then the bank can find itself in a more tricky position. And what's happened since that time is they've committed to their high capital ratios, but we found out that they're supporting their capital through a lot of significant outside investment, Saudi Arabia, other places that are keeping them alive. So it seems like, at least in the interest from the Swiss government's perspective, that in the other Swiss national bank's perspective, that it's in the best interest to maintain and keep the bank growing strong. But it's rated right now by S&P, Fitch, and Moody's as like a triple B rated, like the minimum investment grade credit that you can have. It's risky. So it is risky, and we don't know how risky because of a lot of unknown questions with them. So we'll see how that pans out in the coming weeks, actually. I suspect, though, because of their national importance in international importance globally, that it's going to be a while before we see them, the rug pulled out from under them. It's not going to be an SVB scenario. Cool. Anybody else? Any other questions?
Yes. Any other questions? All right. Well, if there's nothing else, we thank you for spending your time with us today. Hopefully you got some answers. Hopefully it didn't spark more questions based on where everything lies ahead. And hopefully this information is good for you as you think through where the economy is ahead and how you evaluate your job search as that goes on. And yes, so we'll see what happens here in the month ahead. We'll have a recording of this video on our YouTube channel, and we hope that all of you can join us next month as we watch where this economy turns and where it all goes. Thank you all. We'll chat with you soon, and we look forward to having you again. Bye-bye.